We spoke with Carmen Reinhart earlier, and one of the things that she said, which I thought was quite pertinent, is these supply-side issues and price pressures that we're seeing are not as a result of one factor, right? It is not just because of OPEC. We are seeing sort of broad-based pressures as a result of the confluence of different factors. Does that make projections of when this will ease a lot more difficult?
Yeah, look, I definitely agree with that side of it, Heidi. I think the interesting thing from our side is that we actually see oil as a bit of a passenger here to other energy prices such as gas and coal. Clearly, the acute shortages of coal in places like China and India continue to hold markets up at extremely high levels, record levels in the case of thermal coal. But when we look at the oil side, what we're seeing is we have upgraded our oil forecast. We had around $75 a barrel for next year. But now we're sitting around the $80 a barrel mark for Brent crude. And part of the reason for that was a pickup in demand for crude oil for the production of power. Now, many countries don't have the opportunity to switch between fuels, but some countries do, and we think that that'll add somewhere around about 500,000 barrels per day to the demand side for oil.
So in terms of how much we'll continue to see outperformance, how long does this kind of run, right? Particularly as you see other commodities continuing to rally as well. Where do you see pockets of, I guess, less fundamentally driven strength?
Yeah, so I think at least from the coal price side, I think that's probably the market that probably looks the most frothy, largely because what we find is that, and to be fair, while prices have sort of consolidated at elevated levels recently, we've had a reasonably okay October. We haven't had significant cold weather yet in the Northern Hemisphere in most places. And so really how prices trade from here is going to be very much dependent on the weather over the next couple of months. We know that inventories are low in key consuming countries, and they're trying to, in particular for China's case, they're trying to ramp up production and try and bring in more imports to try and improve inventory situation overall. India is doing very much the same. But what we know is that when mines start up, and we are expecting to see material increases in production of things like thermal coal from India and China, two of the world's biggest consumers, those mines are fairly sticky. So you imagine that if it is a warm winter, and we don't know that yet, you could see higher production and relatively okay demand, seeing prices come back very, very quickly.
Okay, so how do you trade commodities-related assets then? Because this GTV chart on the Bloomberg shows how energy stocks have really lagged crude prices.
Yeah, so we're very, very positive still on energy equities. We have a long position in global energy equities. The reason for that is that we think that as OPEC continue to reduce spare capacity, and let's not forget that if prices were to spike above the $90 a barrel mark, let's say, you probably would see additional supply coming into the market from the OPEC countries. That means that the OPEC spare capacity will be withdrawn more quickly than would have otherwise been the case. That gives the world less of a buffer to availability of things like crude oil. And so the consequence of that is we think that the long end of the oil curve can actually outperform the short end of the oil curve, and that's very positive for energy equities as we look forward. The second point I'd make is that a lot of asset managers have been reluctant to add energy back into their portfolios. But what we are seeing is that a lot of asset managers are starting to talk about the benefits of adding energy, and particularly the hedge against inflation. So we think that there is still upside for these companies going forward.
How much are you considering the strength of the U.S. dollar?
So when we're looking at the U.S. dollar, we did upgrade our expectations for the U.S. dollar in the short term in particular. We did expect that we could see some dollar weakening towards the end of the year. We've ruled that out, largely because we think the Fed is going to perhaps move more quickly on the QE side. in the reduction of QE. So we certainly felt that US rates would start to rise. That indeed has happened. Traditionally, yes, the US dollar has been a bit of a headwind for commodities, i.e. a stronger dollar has been a negative influence. But what we're seeing at the moment is very much supply-side driven markets. So we think that commodities, at least in the next few months, can be a little bit more resilient to what usually is US dollar strength. Yep.